hooking up with our guest, the CEO of Entertainment Properties Trust. Satellite issues, you know, what can I tell you? But the cool thing is his name. His name is David Brain.
Who? The guy from...
The guy from Entertainment Properties Trust, his name is Brain. David Brain.
David Brain.
And here we have David D. Brain.
Yeah.
Cheap knockoff, I think.
Yes, the cheap, exactly. Another cheap knockoff. There's nothing you can't.
Was he supposedly born with that name? Or does he watch the show and he just...
I don't know what to ask him. I mean, how do you expect he spells it?
B-R-A-I-N.
Is it?
Yeah.
Not B-R-A-N-E?
Let me guess. His middle initial is T? The? Is that his middle name, David W?
I don't think he went that far to copy David.
Mark, last week we made note of the perception, at least, becoming the reality in the same way it worked to the detriment of the market.
We're back. REITs had their run. If they have, don't sell out to Entertainment Property Trust. Company owns approximately 30 movie theaters. Has a current dividend yield of over 8%. Stock's year-to-date total return over 25%. Has an average total return of nearly 35% over the past 3 years. So let's sit back and enjoy the show with the CEO. Joining us now from Kansas City, David Brain, Chief Executive Officer of Entertainment Properties Trust. Good morning, sir. Thanks for being with us.
Good morning. Thank you for having me.
Got to ask if that dividend is safe.
I'm sorry?
I have to ask, is the dividend safe?
Well, that's one of the things we watch the closest. Yes, it is. I got to tell you, we have a very good cash flow coverage from the stores to their rent payment and also from their rent payment, that is our net income, to the dividend we pay. It's better than 2 times its stage.
You did miss on funds from operations in the previous quarter, though, didn't you?
Yes, Mark, we did by a penny, but the story really was that we delevered the company. We made some considerable acquisitions this year, and in those acquisitions we used a lot more equity than we did debt. As such, we had more shareholders to feed, but the good news is we were only off a penny. We delevered the company from the mid-50% of our capital structure being debt down to the mid-40s. So we also increased the safety and the safety of the dividend in doing that.
We should point out, by the way, for anyone who doesn't know, that Entertainment Properties Trust owns primarily movie theaters, real estate, megaplexes, and there are a couple of combination retail and movie theater operations as well. Let me ask you this. How dependent are you? You're overly dependent, it seems to a lot of people, on AMC. I think they have about 75% of your screens, don't they?
That is correct. AMC is our primary tenant, about 75%. The other way of looking at that, though, is our AMC properties tend to be the number 1 or 2 box office grossing properties in their city. So if something happened to AMC, the likelihood of these going dark or going away is very unlikely, very remote. So we have still a very, I guess, industry credit position dependency rather than an AMC dependency, because we buy only the best leading megaplexes, the most dominant properties in a market.
Given the current concerns over corporate governance issues, do you find it a problem that the CEO of AMC is the chairman of your board of trustees?
Well, that is an issue that has come up from time to time. It's been really the situation since our inception for the last 5 years. We just notched our 5th anniversary. We've had rules, we've had disclosures about that from the very beginning before this became the issue that it has been for the last 12 months. It has never been a problem, and in fact, about a year and a half ago, Mark, we had a proxy contest in which this issue was brought up and really significantly focused on, and ISS, one of the umpires in this area, found that all to be in order the way we conduct business. So this has been an issue someone could bring up, but has never been a problem for the company or its operations.
I read something in the research which, quite frankly, I don't understand, and I'm hoping you can explain it to me.
Sure.
This is from Friedman Billings Ramsey. Industry fundamentals remain strong, but the lack of financing alternatives for movie operators is keeping pricing down, which is favorable to EPR.
Yes.
Cap rates continue to fall among most real estate sectors.
Right.
It's a seller's market. Even though the movie industry is strong, it's still a benefit to you as you go out and buy new properties?
That is correct. It says pricing is down. The fact is that the cinema industry has never been favorably looked upon by the capital markets because it's thought to be volatile. In fact, it's really quite stable, and we take advantage of that fact. we take advantage of the disconnect between the perception and the reality. But the perception is that it is volatile, and therefore, despite the good run that it's having now, in fact, the good run it's had over the last decade or 15 years, the operators don't have many places they can go for their real estate financing. This makes it actually a buyer's market for us.
Yeah.
And so we're in a pretty good position, given their lack of alternatives.
All right. Interesting situation to be in. All right. Thank you very much, sir. Appreciate your time.
Well, I appreciate very much being here. Thank you.
David Brain, Chief Executive Officer, Entertainment Properties Trust, trades under the symbol EPR. Still to come, Mike Haggis goes outside the box with clever covers and has a preview now.